Hello and welcome to BQ Prime. A very good afternoon to all the viewers. I'm Hiral Dadia. Clearly, the selling pressure, the market sell-off has trickled in today's session, and we are seeing an end below the 19,300 mark. Let's welcome in Gurmeet Chadha to understand what is causing this market sell-off in today's session and what could be the way forward. Gurmeet, good afternoon and welcome to the show.
Thank you. Thank you for having me.
Gurmeet, what's the sense that you pick up right now? Because selling has intensified today, specifically with regards to broader markets. And if you see Nifty as well, in the last, I think, 4 to 5 sessions, we've lost almost 450 points. What is it that you're picking up so far?
I think some correction was due in the sense that the global environment has been volatile. The US 10-year has crossed 5% for the first time since 2007, and typically that leads to risk off across emerging markets. We didn't see much impact initially because I think the outlook were being matched in terms of inflows. I think probably have to see the FI number today. Looks like basket selling towards the end. Also, I think there were some pockets. If you see markets, it's not that it's it's a sea of red, but spaces which are of high valuation is where probably more money is getting taken off the table. These are typically mid and small cap counters where we've seen a very, very strong run up. And I think days like these remind you that this is a double-edged sword. If you make the portfolio too aggressive, there will be days like this we can shave off just 10%, 5-10% in a single day from a single stock. So need to be more balanced. I don't see any broader concern, any structural concern with India as such. But you just need to be a little more watchful in terms of how this macro environment pans out.
Right. Gurmeet, just to add to the 10-year bond yield spike as well, how do you think that the Indian markets are taking the Israel-Hamas war and the geopolitical climate, number one? And that's from a global perspective. And then we will talk about the domestic as well. How do you look at this? And is big money allocation actually moving to risk-free assets from here on because of that?
It's very difficult to comment on geopolitical things. We had the same situation with Russia-Ukraine war exactly a year and a half back. So far, I think the world leaders are trying to douse the fire. I think everybody's on an overdrive to ensure that it doesn't spread. But military conflicts, being military conflicts, you can't stay household. But my own sense is that it should get contained. Reason being that all the economies globally, are not in great economic shape, including the Western superpowers. Hopefully, I think in interest of everyone, interest of humanity, this should not spread. Secondly, I think for India, two variables need to watch out for. One, obviously, the spike in the 10-year bonds. Second is any spike in commodity, any supply-led disruption, because that creates impact. As far as India is concerned, I don't see any structural issue. We are in a perfect Goldilocks economy. Our IIP numbers are upwards of 10%. CPI is at about 5%. So we are not too hot, not too cold, 6.5%, 7% growth. And I think we have a good Q3 ahead with private consumption picking up. So in the past, whenever it's been a fall has been due to non-India reasons, it's always been I would still not call it a fall. It's just a one-day movement. But any volatility due to external environment, I think is an opportunity for investors to load up equity.
Right. How are you seeing from a domestic perspective? I understand you're saying that, yes, we are pretty strong as compared to the others, but the earnings season has not been very strong so far. And that's the consensus view that we have been picking up so far. And secondly, how do you think that the markets are taking the upcoming state elections as well? Do you think there is some bit of nervousness about it?
I think early earnings have been a mixed bag. I think pockets where earnings have been good, market has been rewarding it. So even in IT pack, if you see, market wasn't too disappointed with HCL. It was more disappointed with Infosys and some of the others. Similarly, in banks, I don't see ICICI Bank. There's a late sell-off, but markets are pretty happy with what ICICI did or what a Credit Access Grameen did in the microfinance space. Isn't too happy with what some of the other, including HDFC, was a flattish one. So I think it is horses for courses. I think it's a mixed bag, and I think that is how the environment is. If the discounting rate is high, which is the bond yields, market would be very, very clear in terms of. So you have to be careful. Do not overpay for anything. We have not seen this environment. Most of the new investors have not seen high interest rates for longer. So it would be a bit of a learning for us, right? You have to pay the right valuation, irrespective of how good, how high quality the name is. State elections, I think we'll see as we go. I think so far looks like it's going to be, there's MP, there is Rajasthan, which is a main primary concern right now. Let's see which way it goes. But people have voted very differently in state and national elections. We've seen that in Delhi, we've seen that in Rajasthan. In fact, if you remember Rajasthan, the ruling party lost and they've actually won 25 or 25 in Lok Sabha. So people do vote differently, but if there's a very negative result for the incumbent government, then obviously there is some concern which will come up. But I think political things will play out more next year towards maybe February, March.
Right, so Gurmeet, would it be right to say that today's sell-off that we've seen in the markets probably is just a one-off, specifically from the large cap peers? Because if you talk about the large caps, they are offering value. People are talking of valuations which are attractive, as compared to the broader markets where there's so much in an overbought zone right now. The run-up has been so strong, and if that sell-off intensifies, that is going to be stock-specific.
Agree with you. If you see half of the index, which is Nifty 50, for example, HDFC Bank is 14%, RIL is 11%, the IT pack would be healthy double digit. You add SBI, HULs of the world, half of the Nifty hasn't really done well. In fact, probably would be at 17,000 Nifty. So I think it's pretty balanced in my view, and that's how the portfolio should be. I think we should not get carried away. Bulk of the flows have been coming in small and mid cap funds, even for mutual funds, which in my view just tells you how performance gets chased by money in the short term. I think that's something we have to be careful about. Doesn't mean all mid and small caps are expensive. You've got to be more selective. Also, I think there is some juice in the bond side as well. I think inflation will see lower trajectory next year. We have an Indian bond inclusion, which is likely to lead to $30-40 billion of inflow. So there's not a bad time to probably add some long duration government bonds also in the portfolio. Be more balanced. Just do a proper risk reward assessment. There is still double digit to be made if you get your asset allocation done.
Right. But Gurmeet, do you think then there is a probability that the FI money will further move from equity to the debt market, and that is something which could be a risk to the equity markets like India?
Not really. Not really. If you see, for example, this bond inflows I'm talking about is more because of Indian government bond getting included in the JP Morgan index. You'll probably see the Barclays Bloomberg index also. And these are passive flows. So you can't, you come and the active fund managers will follow. Also, FI ownership of India, for example, if you see it's come down from 23-24% at the peak in 2021 to roughly about 17%. So the lowest FI ownership has been about 16% in 2008. So in terms of pure ownership percentage of the top 500 companies, you are at probably a 10-year low. So they haven't been really buying you for us. In fact, I think the overall output would be in excess of $30 billion. So I don't see that intensifying, and we have strong domestic flows. But as I said, you've got to be careful in terms of what you pay. I mean, you can have a period with sharp volatility. So I think there are few pockets where earnings are going to be good. So, for example, I think auto is looking very good, and there was a long festive season, wedding season ahead. I think there will be some comeback in the rural parts of the economy with state elections, with MSP increases, the government doing more property cash transfers, etc. That part of the economy hasn't done well, little soft. Also, the old economy stocks, the cement, the capital goods, the utilities. I think that's where you have valuation comfort and you have strong earnings visibility. So be where the earnings are and be where the valuations are.
Right. And then overall, ahead of elections as well, do you think, cap goods or, infrastructure companies could be playing out as well in a positive way?
Again, selectively, because if you see, for example, L&T, it's a big beneficiary from Middle East. The moment oil crosses $90, you start getting orders. They got a $3.8 billion order from Jafra field of Aramco. And Saudi has expressed its, desire to be less dependent on fossil fuels by 2030. So you'll see a big inflow. There was some concern that, the orders will dry up as we approach elections. But we have seen that if you see the commentary of L&T, they said a third of the orders now is coming from the private sector. So I believe we are in the beginning of an investment cycle, with now private sector probably in few pockets starting to pitch in. Capacity utilization is upwards of 75%. But as I said, you suddenly see stocks go up just because of the order book. X companies receive order, the stock goes up. So orders will take time to get executed. So be careful there as well, right? Do not start discounting 20, 30, 20, 28 earnings, which we have a tendency to do.
Okay. And overall, uh, you've mentioned about, yes, get into sectors which could be beneficiaries of the festive season, selective stock picking. You're talking about infrastructure, cap goods, etc. What would your, recommendation be specifically with sectors like real estate, right? The kind of run up that we've seen with real estate and the profit booking now that has started to come in, is that something as a, you know, as a step that an investor should follow, book profits with sectors which have run up?
Yeah, I'm pretty constructive on real estate. So, for example, if you see DLF, which is again geography specific, the high was 1200 in the last bull run in 2007-8. It's still probably less than half of that. I think anybody which is getting benefited through the upper end, the mid luxury and the luxury segment is likely to better. Their office portfolio also is doing very, very well. Good occupancy, very steady rental yields as well. I'm more constructive on home improvement than just reality. I think if you see, so there is obviously new houses being sold. There's a trend of more spending on existing houses. So we like the cables and wires makers, the tile makers, the pipe makers, sanitary ware. I think this is a more structural trend. And I've made this point earlier that this is a housing-led capex. I think the housing demand is pretty strong. At the lower end, there is government support in terms of Pradhan Mantri Awas subsidy. So you can place some of the home finance, niche home finance names like Home First, etc. So pretty constructive on this space. I think I think there is a secularity of long-term earnings here. So it's good to probably have a basket and have a combination of cement, sanitary ware, tiles, cable, wires, appliances.
Right. So, Gurmeet, very lastly, which are the sectors that you would say are best to avoid at this current point in time?
I personally think it's completely bottoms up. I don't see, as I said, you have good performing, bad performing banks, you have good performing, bad performing IT companies. This is a market where you have to probably be more bottoms up. But one space in general, I think, where seeing lots of this IPOs in micro cap space, in the Nifty Junior Index, a lot of euphoria in small and micro caps, a lot of those companies which are penny stocks going up. Some of the new age companies have done well, like Paytm, Zomato, etc. But all new age companies probably will take time to get out of the woods. So just be careful in terms of what is fashionable. Right? I think right now what is fashionable is defense, railway, just going after the order book, X company receiving X orders. IT was most fashionable in 2022. Pharma was the darling in 2021. Specialty chemicals was the darling in 2021. All fashionable trades lead to large losses. So just be careful, don't chase the fat.
Right. I think stock picking, sector picking, and being absolutely specific with what you pick is going to be crucial as well. Thank you, Gurmeet, so much for joining us on the show and sharing the views. So clearly, this is a one-off sell-off so far that we're seeing. But if this intensifies, then that would warrant another chat as well to understand where we are headed from here on, because multiple factors that we have been talking about as well that could be impacting markets so far. And the key ones being the Israel-Hamas war that we have been talking about, along with the geopolitical climate, the US 10-year bond yields that have spiked past the 5% mark. They have come off slightly from the 5% mark, but still, that is a number that we've been tracking. Because of which there could be big money allocation that could be moving to risk-free assets as well. So a churn from equity to the risk-free assets is something that could be eyed. Earnings from an Indian market perspective have absolutely been a mixed bag. So it's not a very strong earning season that we have seen so far. And lastly, the upcoming state elections as well. That probably could cause some bit of a nervousness as well. So these have been factors that we will keep a close eye on and give you regular updates from here on to understand whether this is something that could continue or not, because clearly there is some bit of value that is emerging with regards to where large caps and benchmarks go from a valuation perspective. But if you see in terms of broader markets, clearly they have been expensive. Yes, there is a sell-off. that has started, and this is not the first time. A couple of weeks ago as well, we did see some bit of a sell-off that started in the broader markets, but that was curtailed. Now, even if it starts, there is a possibility it could be absolutely stock-specific, might not be sector-specific, and there could be some amount of profit booking that could come in terms of sectors that have really run up. So a churn within a sector is also a possibility, or a churn in between sectors is another possibility that we could be seeing as well. So lots could be in store for the Indian markets from here on. That's all that we have on this session. Thanks for watching, and lots more lined up on the other side. Please stay tuned to BQ Prime.